Hello and welcome to today's webinar. Our session today is Behavioural Coaching Through Market Volatility, and it's being presented by our Global Head of Behavioural Insights, Dr. Ryan Murphy, who's joined us and dialed in from the US. My name is Lydia Forsdyke, and I've recently joined the Morningstar Managed Portfolios team here in Sydney. For those of you who joined us at the Morningstar Investment Conference back in May, you may have seen Ryan present. Based on your feedback, he is back today to share the practical behavioural coaching strategies that you can use to help guide clients through volatile markets. The session is about how advisors can help clients stay calm, focused and confident when there's so much noise and markets get a little shaky. Some very quick housekeeping today. Today's session is with the FAAA for accreditation. You'll receive details of the CPD via email in the next 2 weeks. We would like the session to be as interactive as possible, so I encourage you to ask questions throughout the webinar. You can submit these through the Zoom Q&A feature. We will make every effort to address all the questions, but if we don't have time, I will make sure we get back to you with responses post this session. It's a 30-minute webinar today. We will do our best to stick to time, but if we don't and you do need to drop off, we are recording and you will get that recording post this event. And as always, we really value your feedback to ensure that we continue to improve on these sessions and that they are relevant for you and your business. So we'd appreciate that you answer a couple of questions at the end. As always, a quick reminder that today's presentation is general in nature and not to be seen as advice. As such, we've not considered any individual's objectives, financial situations, or particular needs in today's presentation. Before we do cross over to Ryan, some of you may be aware of Morningstar's holistic practice engagement approach. For those of you who are newer to us, we partner with advisors and advisor groups across 3 broad pillars. Today's webinar will be focusing on the first pillar of practice optimization, of which behavioural coaching forms a really key piece of our unique proposition. If you do want to know more about our practice support or any of these 3 pillars, I'll share a slide at the end with who to contact. For now, that's it from me though. I'll hand over to Ryan.
Excellent. Thank you very much for the introduction. Thank you also everyone for being here. I appreciate the opportunity to chat with you about some of our research that we have on volatility. So without further ado, let me jump into this. So I'm sure, as you know, financial advisors must face challenging market environments alongside their clients. And in fact, helping clients withstand uncertain markets is one of the most valuable services an advisor can provide. In our research, we develop a grounded approach for guiding clients through rocky markets, and we captured the top experiences of top advisors who have guided their clients through uncertainty. And by collecting their experiences and lessons, we've extracted insights that you can use with your own clients. But of course, there's always some problems. So one of the problems might be occurring now is that you're not paying as much attention to me as you are as the small white bouncing ball on the screen in front of you. I've done this on purpose, and when I've given this talk in front of large audiences before, you can see the audience's eyes, they're trying to look at me, but they keep getting distracted and pulled back to the white dot. There's just something that's so appealing about it. And part of this is done on purpose. So this is a purposeful distraction I've put in the middle of the talk, and in essence also highlighted that there's 2 parts of your brain, 2 systems that are generally in conflict. So system 1, system 2, you might have heard of these things. System 1 is intuitive and quick and emotive and jumps. It just drives the attention immediately to something that grabs attention, in this case, the distraction. System 2 is much more cognitive, much more effortful, much more rational, but this is hard to deploy and is easily knocked off by something that gets in the way. And part of what I would point out is that in today's environment, distractions are abundant. And moreover, your brain is a pattern recognition system that's working in overdrive. It's so good at finding patterns that sometimes it'll find patterns that aren't even there. And this particular white bouncing dot is not arbitrary. So there's probably going to be emotions that go along with this when I tell you that this corresponds to equity prices in the last decades. And each one of those little jolts up and down corresponds to the movement of literally billions of dollars. So now there's even more attention looking at this thing, and the ups have a positive association, that's gains, but the downs feel more. And it's this asymmetry between ups and downs that's called loss aversion. It's one of the better studied, well-known phenomena that comes out of the behavioral sciences. So all of these features together sometimes make it really hard for people to make good decisions, especially when it comes to money and investing. So let's imagine a very different viewpoint on this. So let's imagine that you had a client and she invested in a particular set of equities, a basket of equities, large cap, global, and she was disciplined in the sense that she only checked the performance of her portfolio at the beginning of every year. On the very first day of the year, she checked what her performance is. What would she see? So if she's been investing since the early 80s, she's seen gains about 74% of the time. And this is what she would observe. Now imagine you had a client who was invested in exactly the same thing. The only difference between these two clients wasn't the investments, but how often they checked. So this person's not going to check every year. This person checks every quarter. What are they going to see? Well, they'll still see it's a pretty good ride, gains about 70% of the time, but a little bit more losses in there as well. Let's imagine exact same investment. So I'm not doing anything fancy here with asset allocation or rebalancing. It's exactly the same investments. The only thing changing is how often the investor looks. So imagine they look monthly. What do you think they'll see? Well, they'll start to see a lot more red. Gains are only going to occur about 63% of the time. And daily, what do you think is going to happen there? Many advisors point out that that's close to a coin flip, 50-50. Yep, it is. It's close. You'll see gains about 54% of the time. And there's a ton of data that's packed in this slide. But the big point of this particular example is not about investments, but it's about how people behave with the investment portfolios they have. And it highlights this mathematical necessity of just how volatility and sampling works. The more often people look at their portfolio, the more volatility people are going to see and feel and maybe even act on. And this loss aversion, this tendency for people to pay more attention to downs than ups, amplifies this particular effect. All right. So all these examples I'm playing with here are time moving through that. And this next example is my favorite plot that's ever come out of Morningstar. And unfortunately, I had nothing to do with it whatsoever. But it shows a very long-term view on markets. And the x-axis here goes from the 1870s, so back about 150 years, to modern times. And the y-axis is value, and it's log scaled. And so this plot would really be very steep in terms of the acceleration and growth of money. One thing becomes very clear. You don't need a PhD in statistics to see that there's a general upward trend of value accumulation, compounding over time. But it's not a straight line. There are definitely pockets of red in there, and sometimes those are prolonged periods in which there's substantial downturns. And I'm not trying to downplay that. I mean, there's world wars in there, and there's lots of volatility that's occurred. But from this particular perspective, it becomes clear that there's this upward trend, and that's really what people are buying into. So part of what we want to do with this research is be able to start to frame and explain what advisors can do to help their clients think about and deal with volatility. And so for this particular study, we asked advisors, what do they do? What works? And we asked a variety of different questions about what they do with their clients during bouts of market unrest. And the results are generally organized as before, during, and after. And at the end of this talk, I'll show you some takeaways that you can leverage and use your own lessons in your practice as you wish. Let me tell you where the data come from. So the data are coming from Morningstar's Global Advisor Panel. And this is a group of advisors that we've invited to participate in research with us. And it's global in nature. It's not just from the United States. We have advisors from the US, Canada, UK, lots of Australian advisors, and South African advisors as well. The mean age of the advisors is about 50, and the average of about 19 years of experience in the industry. To give you some idea of how big the practices are, they have assets under management between 100 to 250 million, and those are standardized to US dollars. So part of what we were asking is, what can people do before volatility hits? And the examples I was showing at the beginning of this talk all were playing with time as a way to think about and start to view market volatility and how markets evolve. And that's this x-axis here. And this is a general picture that I'm going to build up that organizes a lot of the findings we heard from advisors of what they were doing and what was particularly effective for their clients. Part of this is personalization. So the x-axis here is time, but it's personalized to a particular client. So you're talking to a client, here's where they are now. And for them, their goal, their accumulation phase is 26 years before they start to decumulate. And so that x-axis is theirs, and that personalization is valuable. Part of what you're doing here is controlling the x-axis, and that helps reframe people's attention on a proper timescale. And there's a lot of benefits that come with that. If you don't do this, if you don't control people's perceptions of how they think about this and their vantage point, they'll seek out other tools. And for example, they can go online and look at this website. This is called FinViz. It's actually a cool piece of technology that can show you how markets are performing. But what it's showing you is what the markets are doing right now, sometimes delayed only 15 minutes. This is daily performance. And you can see a lot of red and a lot of green. But it's also time, it's very much in short term, right? So it's not just the bouncing dot, but this is the bouncing dot within a day in terms of how this might steal people's attention. Interestingly, whenever I show this slide to advisors, people pay a little bit more attention to this, which is interesting. I think it's rich and colorful, but I'm not convinced it's a really good way to represent what markets do, especially for end investors. And if that's not bad enough, this particular interface requires using a computer. There's a small device that a lot of people have around their wrist and has a handy little app on it that can ding or interrupt you if you let it, talking about different equities that a person might hold. And so this is, always available. People have this and talk about a distraction that's literally that they're wearing with them. All of these sorts of examples are playing with red ink and green ink. They have good design. They're very pretty. You can see the design that goes into it, the design effort, but that has consequences in how it steals away people's attention. Like I was saying before, people are hypersensitive to losses, and red ink really stands out. This is an unfortunate reality of just how the brain is wired, and this loss aversion makes people more attentive to losses, and that can eventually induce them to maybe make worse choices. And a lot of ways in which the industry represents portfolios plays to this, and it's unfortunate. So this is a hypothetical portfolio represented as a balance sheet, and you can look at any platform that has portfolio feedback for people, and it's going to have something that looks very much like this. But I would point out that this is not really a great design if we're trying to induce people to make good choices. What's the very first number people see in the top left corner there? It's what the NASDAQ did or what the S&P is doing. So what the market is doing and the time scale of this is right now, what the market has done in the last 10 to 15 minutes. And if that's not bad enough, the portfolio is broken up into constituent parts. Lots of green ink, lots of red ink. When you look at this, where do your eyes go first? The red ink, right? That's just part of what grabs attention. Those are losses, and that might induce people to start to look and fiddle with their portfolios. Why is this part of the portfolio going down, right? And that's not really how we want to focus people's attention. So part of what I do is research, and I've worked with colleagues at different universities. This was a paper we did multiple years ago, published in a top journal of psychology, which means that almost nobody has actually read it, which is unfortunate. It's serious research. Like in the first paragraph, we're using Greek, and by page 5 or so, we're really developing some interesting and extensive mathematical models. It's dense and it's hard to read, and it's not as though the message really comes through. And it's too bad that in academic journals, we can't write in big red letters, what is the really big takeaway, interesting point. I wish I could, and this is what I'd write on this particular paper. We can help overcome people's loss aversion by changing what they pay attention to. It's very hard to teach people not to feel loss averse or not to fall prey to these sorts of biases, but we can start to change how they pay attention. That can make them less susceptible. And that's back to this example of the x-axis. If we can redirect people's attention to think about investing on these longer timescales, that helps orient them and helps them think about investing in better terms. And many of the pieces of feedback we received from advisors was this kind of reorientation of attention. One of the advantages it has immediately is it helps contextualize existing volatility. So once the x-axis here is stretching, 30 years or so for a particular household, what's happened in the last 4 years is just that little squiggle right there. And what the talking heads on TV are screaming about is just barely a pixel. And that's useful to be able to contextualize that much, much larger. And it also helps, it's a good reminder that being an investor is hard and in some ways unnatural, given how the brain is wired. It requires patience, which requires delaying gratification. It's not something people are naturally good at, and embracing irreducible uncertainty. There's always risk and reward. So why would anyone do this? Why would anyone try and, purposely have to exercise patience and embrace uncertainty? And it's their goals. And one of the motifs that comes up in our research a lot is that people's goals are exceedingly important. And the more that investing can be reframed as a goal-seeking activity, the better off. So advisors can then help keep goals front and center as a way to nudge attention. And that fits into this larger framework. One thing that good advisors do is that they help clients set realistic expectations. So if you ever see a plot that looks like this, that's ever presented seriously in finance, you should howl it down, because this gives people a mistaken impression that there's a nice smooth ride, and that's just not what reality looks like. Turbulence is to be expected, and a smooth ride is not. So don't ever show people a plot like this, because it gives the wrong impression. A better representation would be to start to think about how to visualize uncertainty and remind clients that enduring unknowns is an inherent part of investing. We don't know what the portfolio is going to do in the next month or year or years, but we do have data that shows that how portfolios and markets evolve over long time periods, and their best models show that we can be 80 to 90% sure that growth pattern will be somewhere within that band. Exactly where, we don't know. Nobody really does. And then you can start to overlay on that to show clients what volatility actually looks like. And this particular line here comes from real market data and helps highlight, I think, that there's always going to be ups and downs. It's not a smooth ride, but there's a general upward tendency and a general trajectory of where the growth of money is an accumulation of value. I see some questions coming in, which is great. I'm going to definitely make sure I leave time at the end. And Lydia, please feel free to interrupt if there's something particularly pertinent. I'm happy to do that as a discussion. One thing that plots like this are useful also is when they show volatility, they allow us to show what sometimes the shape of that volatility looks like. And this is real market data. And in fact, this volatility here corresponds to COVID and when the markets lost a lot of value and very abruptly. One of the things that's notable about volatility is that it tends to cluster together. And this is normal. This is a basic part of how we model the evolution of markets. And it's that clustering of volatility that turns out to, when it rains, it pours. And it's something along those lines. So I think that's worth communicating to clients as well. Not only is that this line going to have lots of ups and downs, but some of those down periods will be very steep and pronounced. And that is just simply to be expected. But, to quote Warren Buffett, it's our tolerance for these short-term swings that improves our long-term prospects. And so helping clients understand that this is a normal part of investing, especially over a 30-year cycle, that I think helps get them ready for what they need to do to get where they want to go. Good advisors also help people focus on what they can control. And we know that the biggest driver of investor success is savings and contribution rate. Are people putting aside enough resources, putting it in the market, and then giving it time to play out full market cycles to be able to compound the value they need? Contribution rate is a main driver of success. It's more important than it turns out than asset class selection or some of the other things that folks talk about a lot in the industry. Other thing good advisors do is they help people focus on what matters, bringing this back to very much a goal-centric discussion. In some ways, that helps answer people's why. There's a great quote from Nietzsche. And then because of that, they can bear almost any how. The why here is the goals, what people are trying to accomplish. The how is the volatility. It's a necessary condition and an inherent part of investing. Okay, big point so far. Distractions are abundant, and we are simply wired for being distracted. Thin slicing, checking often, leads to greater perceived volatility. That means seeing fewer ups and more downs, and that amplifies what we already know is this proclivity to feel losses more than gains, called loss aversion. In markets, we know that risk is generally rewarded, but it can take a long time to play out, and markets don't evolve in a straight line. And the more that we can reframe investing as a goal-seeking activity that plays out over the long run, the better. that helps orient people's attention in a way that helps them make better choices. So things advisors can do before. A lot of this is around the idea of education and inoculation. So if you have a client say to you, what happens if there's a recession or a downturn? It's a great moment to stop the conversation and say, if, what do you mean if? You're going to be investing for the next 26 years. It's not if, but how many? And the question is not if it's going to happen, but what are we going to do when there's a downturn? Then now that we're into the notion of pre-committing, having a discussion about this inevitability and having clients start to articulate what they're going to do. And this is a useful touch point for advisors to be able to refer back to clients. Hey, remember we talked about this before. What are we going to do, right? Part of it's also basic expectation management. As it turns out, good portfolios lose money about 4 to 5 months every year on average. That's normal. And I think it's useful, and good advisors do this. They help people understand what anticipated volatility will look like and remind them this is typical and an expected part of the investing process. And this volatility is the ticket to ride. And it's an opportunity to also foster a little bit of a contrarian mindset. So again, back to a great quote from Warren Buffett, be fearful when others are greedy and greedy when others are fearful. Sometimes market volatility can be welcome in the sense that it does bring discounts and mispricing. And if people have capital ready to deploy, they can certainly do so in ways that help them in the long run. So during volatility, so what we see is who reaches out. And we saw that most common thing that advisors reported was inexperienced clients who either new to the investing process or new to the practice. Clients who are relying on investments for income as well tend to be more likely to reach out, as well as clients who are a bit more anxious or worried. And for that category of worriers, there's things like risk tolerance questionnaires. Morningstar has this, the Finmetrica technology and tradition. We use this as a way to measure people's risk preferences. And that can be a useful way to start to highlight which of clients might be a little bit more susceptible to the anxiety that volatility can bring. What do clients talk about? What do they ask? The vast majority are asking about market dynamics, having questions about the causes of volatility. What's driving this? Now, obviously, markets are exceedingly complicated and sometimes the causes are multifaceted, but it's useful, I think, for advisors to have a couple talking points on hand ready to give some account, some idea as to what's driving the volatility. Performance, people have questions about this, inquiring about how their investments are faring. I think I had one advisor explain it to me. What people are really asking isn't about performance, but are they going to be okay? Are they going to reach their goals and accomplish what they're trying to accomplish? And that I think is a useful insight when you have clients asking about what the performance is, they might actually be asking a different question. There's some additional points there, which I can lead you, or you can look over it on your own time. One thing that we noted is that how rarely clients asked about opportunities. That happened less than 6% of the time, and less than 3% of the time clients asked about their goals, thinking about long time scales. Again, volatility makes people focus more on the here and now, and that sort of can be not particularly productive for helping people make good long-term decisions. So few people ask about opportunities, and I think that's an idea that advisors can start to plant the seeds of early on before volatility hits, is that when volatility occurs, that's a useful time to have capital because there can be mispricing in the market, and it's a great time to get some great investments at a bargain. That contrarian mindset, the seeds of that can be planted long before volatility hits, and it's something that indicates that the data indicates that most clients don't have this orientation. So during volatility, what can advisors do? Well, I've been harping on this point of a long-term perspective, and this is something that we heard over and over again from advisors, reorienting discussions to a proper long time scale and reminding clients that volatility is normal and to be expected. Like we talked about before, going back to these touch points of conversations about volatility as an inherent part of the investing process. Some of the advisors we talked to said they were emphasizing focusing on listening and asking questions, helping clients better understand their concerns and be able to articulate them and their situation. And sometimes it was just asking the right question and letting the client talk a little bit. That was a useful way to start to get them back on track. And this notion of framing volatility as an opportunity, encouraging clients to consider the bargains that market panics can bring. So one of the things we asked the advisors was, what have they learned to do differently given all of their experiences through volatility and multiple market cycles like this? One of the most common answers we got is that there was a shift in how they thought about what their job and their focus was, from investment focused to much more about the investor, much more about being a coach, being a mentor. This coaching element came up repeatedly for lots of different advisors, and that they saw that that was a maturation of their view as to what their role was. Advisors reported increased confidence. They've been through this before, and they felt that they had improved ability and confidence to anticipate and address client needs and the kinds of questions they would start to see. And they developed some enhanced reassurance tactics. So targeted proactive outreach, reaching out to clients before they call, personalized feedback around goals, and remind people why they're investing in the first place. A lot of this comes around just preparation and education. So prioritizing preparation with clients for volatility and educating them on what to expect. Part of that is also improved communication skills, active listening, empathy, avoiding jargon, and tailoring conversations to where clients are and their understanding. And even some key stats was a piece of feedback we heard from some advisors. For example, advisors have a ready fact on the top of their head that in the last 90 years, there have been 15 recessions. Now, most people don't know that. But once you start to give that statistic, you can start to help people realize that this has happened before, and we expect recessions with some degree, some regularity, some cadence, and this isn't the first time. Bear markets happened 6 times in the last 50 years, 9 times if you change the definition just a little bit to be a 19% drawdown. And that, once clients start to see that, they realize these are the sorts of things to expect every 5 to 7 years. And so that, I think, helps reorient attention and helps people think about what they need to do given the market realities. Okay, so we've written up, let me just in the interest of time show you that we've written this up in a white paper with the rest of the behavioral science team. Danielle and Sam and I wrote this paper. Lots of the details are in there, and we're happy to share that out. But what I'm particularly proud of is in the back of this is essentially a worksheet that you as an advisor can use in your own firm to start to be a little bit clearer, ink to paper, about what you do with clients before and during and after volatility, and starting to think about ways you can expand the tactics and techniques that you use, maybe drawing some lessons that we've shared here with what other advisors are using and what works well. There's a lot of value in getting this out of advisors' head and starting to put ink to paper as to what they're going to do in their practice as they start to deal with different clients who have different needs, who are all going to be experiencing the same inevitable volatility. So let me pause there and give time for some questions and comments, which I'd love to be able to hear from.
Thanks, Ryan. I might just, in the interest of time, try and have a look at a couple of questions here. We did have one that really does relate to a little bit around technology and the way people have access to portfolio balances now in the way we didn't a long time ago, right? And perhaps, on your phone and seeing markets move at a daily level like you showed on our first couple of slides. But then the interesting point that was made by someone online today is that, the same kind of impact on property prices is not felt because they're not getting an alert every day saying, oh, your house is no longer worth what it was yesterday. So I suppose the question is, do you think technology has played a big role in our behavior? Or could it be something that helps?
Could it help? Yes. Is it going to typically help? Probably not, I would suspect. I think that this example that I built up in the beginning of the talk, this notion of how often people check is really useful. And that's just a function of how the math works. If you check more often, you're going to see and experience more volatility. And I think online tools that look like this are really interesting and enthralling. It grabs people's attention, but it's not at all obvious to me how feedback like this is going to help people think about a long-term investment strategy, nor give them really good insights into how markets evolve and change. Again, I mean, this is the plot I really appreciate the most. And year to year, it doesn't change. It just adds a couple pixels on the far right. Because what it's really getting at here, what this plot's getting at, is the enduring behavior of markets and what happens to the long-term appreciation of capital when people participate in these markets. And I think this to the extent that we can have technology remind people that this is the reality versus whatever is jumping on their smartphone, I think. And that's not to say that technology is all bad. I wouldn't go, along those lines. But at the moment, it strikes me that it's causing more problems than it's fixing.
Yeah, I would agree with that. We've had another one just come through, and this relates to your slide around how advisors can help and perhaps jargon. We all know, being in the industry, we can sometimes be in a habit of using particular words. The question was, is there any language to avoid so as that we do not maybe scare clients?
Mm-hmm. Well, I think, not to scare clients. Well, I think, and there's a great quote from Mike Tyson, right? Everyone's got a plan until they get punched in the mouth. And I think good advisors recognize that, and good advisors maybe do scare their clients a little bit, just to help them understand what volatility is going to look like, and just have some idea of what to expect as they invest. And there are going to be periods in which there's substantial volatility. And I think early on in the process, it's worth having just a factual conversation about, it's not if this is going to happen, but when and how often. And during those drawdowns, that can be a reduction in portfolio values of, say, 20% or so. That's not unheard of or even uncommon over 20 to 30-year stretches. And maybe even translating that into dollar amounts to help clients understand what that's really going to feel like. Because 20% is pretty cold. But if you're talking to a client who has $1 million portfolio, that's the eradication of $200,000 on paper. And I think just helping people start to appreciate that that's part of what this ride is about is important. So scare them away. Obviously we don't want to do that. But at the same time, I think that early on, before volatility hits, that's when advisors have the opportunity to really help people understand what to expect and what is a natural part of this process. But again, I think as much as we can remind clients that they're buying a ticket to this system that compounds wealth over long periods of time. It's not a straight line. There are going to be drawdowns, and there are definitely going to be rocky periods. But really, this is what they're participating in to help get them closer from where they are now to get closer to where they want to be. And ultimately, that's their goals. And market participation helps accomplish that.
Excellent. We've had a wonderful comment just tying into that first question, which was that this advisor poses the question to the client, if your home were to fall 10%, would you sell it? And generally, you would expect that client would say no. So some really good themes here. I know we are just over time, so I might actually just quickly wrap it up. If there were a couple we didn't get back to or didn't have time for, we will come back to you on those questions. But in the world we live in, where multiple concurrent wars are going on, uncertainty certainly isn't going anywhere. And now more than ever, the value of your advice is crucial. And keeping clients calm and on track to reach their financial goals is so important. So thank you for coming. If you did miss the intro, CPD points, the slides and the research pack, as well as the recording of this event, will be in your inbox soon. We hope you found value in today's session. If you do want to chat to one of our team members, we have local teams across the country who would be happy to continue today's discussion. And lastly, our next investment webinar is in 2 weeks on Tuesday, 21st of July. So watch out for invites. Thank you so much again, Ryan, for joining us. And thank you everyone for being here today. Enjoy the rest of your day, and thanks for your time.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.